and we will record this session. So again, the basic principle of the foreign tax credit limitation is this formula. I told you I'd come back to this formula. I'll have excuses to come back to here several times. So the basic principle of Section 904 is the credit is limited to the ratio of foreign source taxable income to worldwide taxable income times the current year tax. And any excess is carried back 1 year, forward 10 years. This limitation and carryover process is applied separately for each of the two baskets, general and passive. And again, passive basket is interest, dividends, rent, royalties, some foreign exchange gains, and gains on property that produce this type of income. I'd like to mention now one thing that you see mostly in the individual area related to the foreign earned income exclusion, but also applies in the corporate area. To the extent there is any tax, foreign income tax, allocated or apportioned to income that is excluded from U.S. taxation, then that foreign income tax is not eligible for a credit. Again, this you see more in the individual area than in the corporate area. There's a separate limitation by basket. There's also a separate limitation for AMT versus regular tax. These limitation computations are done completely separately because of the difference in the formula for AMT and the general basket. The determinations of what is taxable income are different for AMT and regular tax. There are depreciation differences and a wealth of other differences. As a result, we have to do two separate computations each year for each basket, and it can get pretty complex. So let's dive through one of the exceptions to the passive basket income. Passive, again, is interest, dividends, rents, and royalties, but passive basket income received from a CFC, as well as dividends received from a non-controlled 902 corporation, are looked through. Why should we treat dividends from a CFC any differently than we treat branch income? That's the whole idea of look-through, is to give us equality of treatment, if you will, between the two types of income. So we don't pick and choose how we go about setting up our foreign businesses based strictly on U.S. tax concepts. This is inherently not a mechanical or tax policy rule, but just an issue of fairness. Look-through applies to all the varieties of passive income, and the only effective look-through is to treat that passive income as general basket income. And we determine what the income is that we are looking through by looking to how either the earnings, in the case of dividends or subpart F, were basketized, or what the corresponding deduction was charged to at the CFC level. If we have a CFC that pays us interest and the CFC earns all general basket income, then that interest paid to us by the CFC is treated as general basket. Before we get into this look through on a type of income by type of income basis, we need to look again at the definition of passive. And passive is defined under the subpart F rules. And those rules have a whole bunch of exceptions. In the video, I talk about the exceptions for high tax kickout and look through. To reiterate that a little bit, the high tax kickout says that any income subject to a high rate of foreign tax, meaning in excess of the U.S. top tax rate for the type of taxpayer, is treated as general basket, not something else. And the look-through rule says if the item is allocated at the payor level to something that is not passive basket, then the item is not passive basket. But again, passive has some exceptions that are defined in subpart F. And these can have an effect on the characterization of what we're going to talk about next. So I want to cover them just very briefly. Subpart F says there are certain exceptions to subpart F income or passive income. First, same country items are looked through at the CFC level. If we have an item of rent that is paid from one CFC to another, and the rent is for property used in the same country, then that rent is looked through even at the CFC level to see where the rent expense goes. Let's take a quick example. Our French subsidiary rents a factory building from another French subsidiary. The rental income of the property owning subsidiary is treated in the same basket as the property renting subsidiary. The tenant allocates the rent expense. In this case, it's a factory building, so all of the expense gets allocated to the manufacturing of goods, and that's general basket. So the rental, let me try that again. So the subsidiary getting the rent income is treated as having general basket rent income. It works similarly for dividends and interest from a same country corporation. If my French sub pays another French sub interest, then we look to where the interest expense got apportioned to characterize the interest income. Now this is exactly the same sort of look-through that we have for items coming to a U.S. person. So these same country items function the same way, but their practical effect may be to treat some of that income at the subsidiary level that might otherwise have been passive as general basket, so that when it comes out, it's still general basket. Active rents and royalties are also treated as general basket and not subpart F income, both general basket and not subpart F income. There's some limitations on this in subpart F that we'll go through in detail. Now, an active business rent or royalty doesn't mean the same as it does in the passive activity rules. It's defined by the level of activity of the subsidiary that's doing the activities. And again, these two items, the same country rules and the active business items rules, all relate to controlled foreign corporations and under subpart F. There's another section that kind of throws out a lot of the things and causes a lot of income not to be considered passive, but it has expired. It's been renewed several times. It's section 954C6. We'll talk more about that in subpart F, even though it's obsolete, or at least is at the moment. If your employer or your client has paid enough money to the right congressman, they might know whether this is going to be back or not. When we're looking at things at the CFC level, there's an ordering rule for allocating deductions. We cover this ordering rule in the video, and I'll cover it again a little bit tonight in the webinar. So let's look at the different things that we might be looking through. We'll start with the easy one, rents and royalties from a CFC. If a U.S. person, individual or corporation, receives rents or royalties from a CFC of which the U.S. person is a U.S. shareholder, then we look through the rent or royalty income to where the CFC apportions or allocates the rent or royalty expense. Now, as we'll discuss in the 861 module, the the allocation of rent and royalty expense is usually done on a factual basis. Sometimes we have to split it up, but usually there's a one-to-one correspondence between a particular item of rent or royalty expense and the income that it's generating or helping to generate. For instance, we might have rent on a factory building that generates general basket income. We could have a royalty on a patent or a trademark that generates general basket income. So we have to look through these items of rents and royalties. Now that's to the taxpayer's advantage because generally taxpayers tend to have foreign tax credit limitation problems with respect to general basket and don't have them with respect to the passive basket. So let's go back to that formula again. Thinking this through, this is based on net taxable income. If you have interest, dividends, rents, and royalties, or certainly interest, dividends, and royalties, you don't tend to have a lot of expenses associated with them. With rents, you might, but interest, dividends, and royalties, often there are very few expenses. And often, especially with dividends, interest, and royalties, you may be subject to a flat foreign withholding tax that is significantly below the U.S. tax rate, sometimes zero. So passive income often has very low tax associated with it, where operating income often has fairly high foreign tax associated with it. The next item we look through is interest received from a CFC. And this interest income, we look to how the interest expense is apportioned at the CFC level. So the first step in looking through interest income from a CFC is to get at the CFC level and determine the apportionment of interest expense. Excuse me. Then the character that interest expense takes on flows through to the income for the U.S. person. This flow through also applies, as I said, among CFCs, but there's a twist. When we're doing apportionment within CFCs, there's an ordering rule for how we must apportion interest, and it's a fairly complex rule. Let's switch over to that at the moment. there are several steps that we have to follow. I'm not, in your notes on foreign tax credit limitation, there is a fairly complex example that I've decided is just a little too complex to do in an online course. When we do it in a live course, usually I have to go through it 2 or 3 times for people to get it. So anyway, here are the steps. First, we have to determine the CFC's gross income by basket. Then we allocate directly related expenses. And remember, we're talking about 861 type concepts here. Then, before we allocate anything else, we allocate, not apportion, allocate related person interest expense to passive foreign personal holding company income to the extent there is any. Any balance of related party interest expense then gets apportioned along with everything else. After we have allocated the related party interest expense to passive income, then we apportion the rest of the interest expense based at the CFC level, based either on the gross income method or the asset method, using these pretty simple formulas. Once we have apportioned the interest expense, then we allocate other expenses or apportion other expenses to the extent necessary. So this gets fairly complex to determine where interest expense gets apportioned at the CFC level. One thing I want to cover here just very briefly is the circularity problem. I'd like to draw something here for you. Let's say we have 3 different CFCs, and the CFCs pay money to each other. How do we deal with this? If we've got this circular flow of payments, how do we deal with this? We're supposed to directly allocate interest expense to related person, we're supposed to directly allocate related person interest expense to passive income. But if we've got these circular payments, how do we do it? The way that's usually done and the way the regulations suggest is we start with the smallest one and work our way up. So this problem of circular payments can be really acute in the interest apportionment area, as well as determining what part of interest is passive income as opposed to general basket income. Our next item that we look through is dividends. Now, for dividends, there's a little bit broader rule on look through. Instead of just looking through payments from CFCs to the U.S. shareholder or payments among CFCs, we look through payments to the U.S. from non-controlled 902 corporations. Now, what do I mean by this? Well, a non-controlled 902 corporation is a foreign corporation that is not a CFC. In other words, it's not a controlled foreign corporation, in which the U.S. person owns 10% or more of the shares. That 10% threshold, if you'll recall, is the same threshold as for getting deemed paid credits under Section 902. So again, this look-through for the 902 type dividends is to our advantage, because this says we have the potential of recharacterizing those 902 dividends, the dividends from a 10 to 50% owned subsidiary, as general basket. And if they're subject to lower foreign tax, it's great. If they're subject to higher foreign tax, well, that's good as long as we can use the credits. So this is a sword that cuts both ways. The dividend is looked through based on the earnings and profits of the subsidiary paying the dividend. Now, in the CFC to CFC level, the tiering up of earnings under Section 902 accomplishes exactly the same thing as look-through. So this provision on looking through dividends basically accomplishes what the tiering up does for the 902 deemed paid credits. We have to look at the lowest tier of subsidiary and determine what the E&P is by basket, and then as dividends are paid up the chain, we have recharacterization of those dividends or the earnings flowing up from passive to whatever it was below. When they finally get to the U.S., then that dividend is recharacterized based on the earnings of the sub. Now here I ask a question. Is it possible? This I don't know the answer to, and I'm sure there are some theoreticians out there that can tell you. Is it possible to have passive dividends other than non-controlled 902 dividends? Because subpart F comes first. When you have a subpart F inclusion, you don't pay tax again. So we'll talk more about this when we get to the subpart F module. Now, before we move on from here, I'm staring at, usually at this point, I'm staring at a lot of faces looking like a deer in the headlights. This is the point in the course that things get hard. Because this is the point at which we start getting the interaction of three different sets of rules. Let's go back to that chart I drew, and we'll do some things here. If the computer will cooperate. We've got three different sets of rules here that interact. We've got the 904 rules, the 861 rules, and the subpart F rules. Oops. So the interaction of these three sets of rules can make it quite difficult to learn any one of them till we get toward the end of all three sets of rules. The 904 ones are the simplest of the three pieces. In the 861 module, we'll be covering the allocation and apportionment of deductions. And in subpart F, we'll be covering the requirements for a U.S. shareholder to include part of the subsidiary's earnings in his earnings, whether or not they're distributed. So makes it a little tough. Now, when we are determining which things are passive and which aren't, we have to make the determination on an item-by-item basis. But fortunately, item doesn't mean every little piece. We group things together and treat a group of things as a single item under these 904 passive activity rules to determine whether that item is passive or not passive. The three primary groupings are based on withholding rates: 0 to 15%, 0%, 0 to 15, or 0 plus to 15%, and more than 15%. So we initially may have only 3 items, and we have to make the determinations for the high tax kickout and the look-through rules based on each item as grouped. Within each CFC, again, remember we have to do this look-through stuff to look through to the CFC. So we have to do these determinations at the CFC level as well as the US level. At the CFC level, we also have to make separate items for each qualified business unit of the CFC. Now, the QBU is a concept in the foreign currency area. The audit folks that are dealing with international probably already know about qualified business units because they have to determine foreign currency items at the QBU level. And book and tax qualified business units are usually the same. Now, fortunately, since we're already at the CFC level for making our determinations, we may only have a single QBU for that CFC. If it doesn't have any branches outside its country of incorporation, then we still have just one determination for the CFC. And the QBUs then get grouped. So I'll refer you to the video on 904 for me to discuss a little bit more about these grouping rules. Now, there's one additional grouping rule that only applies for Section 904 and not anything else. Separate rent expense item, separate rent or royalty expense items allocated to any item of income or group of items of income causes all of those group items to be treated as a single item. For instance, if we're re-renting some property, then this rule is triggered. In practice, I haven't seen this really have a lot of application. Then the final bit that I want to discuss today is allocating taxes to the various items of income. And here we're talking about allocating foreign income taxes. When my CFC pays foreign income tax, it does so under foreign rules, not US rules. So our first step in determining what income tax goes with what income, net taxable income, is to look at the foreign rules to see what they say about it. That may be as far as we need to look. We may find that the foreign rules say this kind of income is subject to a separate tax than this kind of income. And if that's the case, then we have just a direct allocation. But if one particular kind of income under the foreign rules is a mix of general and passive income, then we have to apportion that tax between the general and passive income. And then we look to US rules to see how that apportionment is done. I cover 2 different examples in the video about allocating and apportioning foreign income taxes you need to really focus on those examples in the video. One of the examples discusses the differences between U.S. and foreign concepts in terms of what effect it has on allocating the we'll do a little bit of mute there. It discusses the difference between the effect of the differences between U.S. and foreign rules in allocating the income taxes. For instance, if we have a timing difference that results in more income this year and less income next year from U.S. versus foreign, that timing difference reverses at some point in the future. But the foreign tax is imposed under the foreign rules, but we have to allocate it year by year. So when we have that timing difference, it causes a shifting of tax between baskets, or the potential for that to happen. And the shifting can have rather major impacts on our ability to use the foreign tax credit. Another concept difference that causes some real problems is what if the income is not, something is income under U.S. principles, but not considered income under foreign principles. What do we do with it? Well, the regulations say that's treated whereas income under U.S. principles and not income under foreign principles, we still may have to allocate an apportion. Where it's the other way around, where the foreign rules say it's income and the U.S. rules say it's not, then it's treated as general basket. Now, this is not a favorable rule because remember, our problem with this limitation usually is not in the passive basket, it's in the general basket. So when we have these foreign taxes that are allocated willy-nilly to general basket and we don't have any income to go with it, then it worsens our foreign tax credit limitation problem. I have encountered situations where we have excess limitation, and those are good. Then I can make some sort of plays with something that will trigger foreign income taxes now versus later and reduce my overall U.S. tax. There are two other rules I want to mention that we're not really going to cover in this webinar or the course. You need to be aware of them, but the complexity level is just a little too much. Both of them have to do with recovery of foreign losses. Let me see if I can find the right presentation here. Bear with me a moment. Okay, we do indeed have it. It's possible that the allocation and apportionment rules that we'll talk about in the Section 861 module can cause a loss in a particular basket of income or a particular year. When we have a loss, the rules under Section 904F say we have to recapture part of that loss in the future before we can start using foreign tax credits. So we have to recapture 50% of our taxable income, or let me try that again. We have to resource or treat as domestic up to 50% of our taxable income as take it out of foreign source and put it in domestic source if we've got an overall foreign loss that has not yet been recaptured. We can elect to recapture more than the 50%. And we have to do that recapture until we've or resourcing as it's called, until we have gotten rid of that overall foreign loss. There's a similar provision on overall domestic losses, and that began for losses incurred after 2006. So unless a lot of our companies have net operating losses from that 2008 to 2011 period. And if we have a domestic loss, then we have to do some resourcing of that domestic loss when we start having foreign source taxable income before we can claim foreign tax credits. So again, we're not going to go into great detail in this course on the overall foreign losses and overall domestic losses. You need to be acutely aware of those. So, at this point, I'm going to unmute everybody. And well, we've got somebody with background stuff going on there. If you could mute, that'd be great. If you have any questions, start asking. Okay. Any questions? Okay, with that, I think we'll conclude this webinar. Okay, Anna had a question about the resourcing of the lawsuit.
I'll show you what to
I'm going to mute everybody there. The overall foreign loss is recaptured. Let me get a notepad here. We'll go into it just a little bit. Let's make it bigger. So if we are in an overall foreign loss recapture situation, then we have to treat 50% of our foreign source taxable income as domestic until we've recaptured the overall foreign loss. So we are resourcing that foreign source taxable income as domestic source. The overall domestic loss provision works very much the same way. And again, I don't really want to go very much deeper into this one because of the complexity of it. Okay, any other questions? And by the way, I'd be happy to discuss with any of you offline the overall foreign loss and overall domestic loss provisions. Okay, other questions? Okay, well, let's give you a moment if there are in the recording.